Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
It's Money on Tap's insightful Summer Sector Series, diving into the hottest investing sectors for the season. Each week exploring a different high-growth industry, analyzing major players, market trends, and emerging opportunities, with expert guidance to make smart investments all summer long. Today on Money on Tap, Beyond Brick and Mortar, the real estate sector. Your summer school session starts now.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or moneyontap.com. My name is Seth Cressman, here with Ben Brayshaw and Dan Mickelin. Gentlemen, how are you today?
Doing great, Seth. Doing great. How about you, Dan?
Doing well. We're just talking about kind of wrapping up the summer, back to school kind of stuff. So it's that time of year, time for new beginnings.
We didn't do a back to school show this year. We got going on so much other great stuff. We just completely flew by. We'll figure it out. We'll do a mid-year back to school.
Got real busy with the Summer Sector Series, so it's, time flies during the summer.
It has been a great summer. If you're joining us for the first time, welcome. We're glad you're here with us at Money on Tap, and a little bit of the lay of the land for you. First of all, I want to thank you for subscribing to Money on Tap in the podcast world. That helps us out tremendously. And if you want to take it one step further, please drop us a comment or some stars in the ratings if you're listening to us in any venue out there that allows you to do that. That just helps us out. And when you do that, as a thank you, and because we want to connect with you more than just podcast, radio show, we'd love to send you some Money on Tap gear. Send us a message at info@yourmoneyontap.com. Again, that's info@yourmoneyontap.com. Or give us a call at 855-226-8551, and we'll send you out some Money on Tap gear. And it's good stuff, people. A lot of fun times here at Money on Tap, and we appreciate you. We love connecting. The series that we've been running for the entirety of the summer. I guess that depends on when you start your summer. There's different, could be May, could be June. But in June, we started to dig deep into this summer, and what we wanted to do as a show and as a group was bring to you some layers of investing. Okay, so there's all sorts of slices and dices on the market, and the market, the S&P 500, is broken into 11 sectors, and each week we've been highlighting or featuring one of the sectors of the S&P 500, and eventually all good things must come to an end, meaning we're getting to the wrap of it, the end of this series, and we've saved some of the best for last, as we should, in the real estate sector, and it is going to be fantastic if you're joining us for the first time, or if you've been a real estate investor, or if you're looking to become a real estate investor. What a great show for you to be a part of. And also, please take it, share it, send it to the people you love and you care about, and get them in the room so we can all grow together. It's one of the biggest things we love to do here at Brayshaw Financial Group and at Money on Tap is increase our knowledge, and just day by day, just do something to continue to grow in our understanding, and that benefits not only us as you, but it benefits the people around you that love and care about you, because you're doing something good for you, and that's in turn doing something great for them. So, wow, we got into some, we got into a little bit of philosophy, pull back the veil a little bit further and get into the heart of it here with us at Money on Tap. With that, you guys, I think that's all I got for the show. If I'm going to go ahead and drop off now, and you guys want to take over, I really feel like I've done my part. So thank you.
I think the real estate world is something that, out of all the sectors that we have covered so far, this is our last sector, and that's pretty neat. It's been a nice journey. I've learned stuff myself. I've been challenged by things I thought. I've engaged in things I hadn't thought of engaging in before. I mean, it's I can never learn everything in this in the financial world. I don't think anyone can. So, but I think the real estate sector is the one area where people can relate with the most. I mean, people either own a home, they understand the apartment, concept and rentals and their landlord, or they even own a duplex or rent out a basement apartment, or maybe they own a small, little triplex, quadplex, or maybe you own a couple of office buildings. This show is for you. I mean, if you say, hey, I understand real estate, well, you don't understand everything about real estate, because even I don't, and I know a whole heck of a lot about real estate in lots of different domains. And this show, I think, is going to cover the ability for those who maybe don't have the acumen for managing their own real estate, or maybe expanding beyond the basement apartment, or renting a room out in their house, or me and Dan do to our wives. We rent them a room, right, Dan?
That's right.
So, there's always income revenue opportunities around, and we try to exploit all of them. But that being said, as you're diversifying your portfolio, there's so much in the real estate world. So we're not going to be able to cover it all. And if you're selling real estate and you don't want to avoid taxes, those are things that we work in. Those are spaces where if you're hearing, I want to sell my triplex, call us. We have, tax incentive opportunities to help you out in the dissolution of that, and try to mitigate some of those taxes. But if you're looking to diversify in real estate, there's a lot of really great ways to engage in that. And I'm excited about this show because we're going to educate a lot of people in a lot of different areas about real estate.
Yeah, I think the title of the show is Beyond Brick and Mortar, Understanding the Real Estate Sector. And I think that's what we want to focus in on is, those investable opportunities in real estate that don't require you to close on a deed or close on a property, right? How do you get money into real estate, be invested in that as a kind of a non-correlated asset, but also find a way to do it with a high degree of liquidity? And I think that's one of the benefits, for anybody listening here today, that you're going to take home and understand a little bit better, how you can get into the real estate world, but have an easy exit as well.
You nailed it. You guys can't wait to get into this. We got to get going, and it's time for Money in the News. Target may have solved one of retail's biggest problems, theft. Thank you so much. This is a Yahoo Finance Brooke DePalma article, and ticker TGT, Target is hitting its goals on inventory shrink. So if you're not familiar with the Target story, and it's been a story across the board with a lot of retailers, but especially Target, just getting hit really hard on its inventory shrink. And that's one of the tailwinds to the profit for the quarter. And so as stepping into the year, their aim was to shrink or plateau and improve the deterioration that they've seen over the last couple of years. And in the last 2 quarters, they feel that they've really made some progress here. The damage really being done by several stores or locations that just was not able to get their arms around theft. And, one of the solutions that they've had is really to close several locations. And as I read through the article, I was like, well, look at that, Portland, Oregon, where I happen to be just outside of, taking a few of their locations off the map. 3, as a matter of fact, in Portland, Oregon, San Francisco and Oakland, and New York City in Harlem. And, that was one of those things that was really hard for me to say or see, that my beloved city of Portland has been a problem child for retailers. And, if you want to go back and take a look at Portland and the history of what's happened in this city, it has been a really big transformation, a really hard thing to be witnessing. And I'm actually grateful that Target's done what it needed to do and shed some of these stores and is focusing on locations where the municipalities, for one, are supporting what needs to happen to stop theft in their stores.
Yeah, it was really a significant impact. They recorded $500 million in loss in 2023, which was on top of $700 million from the store in 2022, and that related to a 1.2% loss in their operating margin just from the theft alone, which is an absolutely staggering number when you think about it. But the fixes on it, seem to be pretty simple, and some other retailers have begun to follow suit with some of the same steps, some taking a little different approach. But, one of the simplest things that they did is they started locking up, the merchandise that was stolen most frequently, which you think would be,
Have you seen some of those pictures, Dan, of the lockups? I mean, it's like entire aisles of things locked.
And I've seen some of it. I don't know if it's memes or if it's true, because it looks like really trivial items under lock and key. But, I hope some of that's a joke. But honestly, this theft thing is a clear as day issue. And I mean, we see it all over the place. I mean, really, it's not just, kind of the needy walking through, grabbing things here and there. I mean, this is organized in mass, large groups of people breaking glass, grabbing everything and running for the door. I mean, with any semblance of law and order, you just can't stand for this kind of stuff. It's crazy. And I don't expect that to be, a Target employee issue. I mean, no one needs to lose their life at the gate over, retail items being stolen. I completely get that. But, the police involvement or, there just has to be some organized effort to match the level of organization that's going into the theft to overcome this challenge for sure.
Well, what I think is funny is that, I don't know about you guys, but I hate checking myself out at these stores. Like, I like you're waiting and everything else. It's like, whatever happened to all the people they used to hire? Well, they've realized that actually those people are worth something that a lot of people hadn't thought of, which is they're anti-theft protectors. And so a lot of these stores have been implementing, people to check you out now. And taking away the self-service line. So for those people who like, someone to help them with their, cart and bags and everything else, well, that now exists again, and they found that has helped. I think it's interesting that, between, Target and Walmart, Walmart year to date's up 42%. Meanwhile, Target's only up 13%, and it's had a recent jump recently. And that being a lot to do with, their anti-theft, instillment. I mean, it's they've put more security guards. They've locked stuff up that's of high value or even irrelevant value in some of the more hard hit theft places like Seth's hometown. And but this is a learning thing for a lot of organizations in understanding. Hey, we need to put other parameters in. I think it's funny because you get. You walk in. People walk into Walmart, walk out with stuff all the time, and they've cut down on that. But you have a Sam's Club membership, which is owned by the parent company. Like, they have your name, your address, your social, your date of birth. They have every piece of information on you, and you go to the checkout line, and guess what? They treat you like a criminal. So it's exactly the opposite. Meanwhile, they have all this data. I know we've joked around about that before, but I think it's funny that you could just walk into any store, no one checks your receipt, and that's fine. But where you have a membership, they're like all over you about it. So I do think it's kind of unique, but we really do need to have these protocols, because who pays for all of this theft? We, the consumers, who actually pay the cost of this stuff. I mean, they have to figure out how to mitigate that cost, and they just price everything higher. So I'm glad they're doing this. This will make them more competitive price-wise.
Yeah, I thought one of the simplest things that a different store took as a concept here to prevent the loss and the theft. This is TJX companies, who's TJ Maxx, Marshalls, Home Goods. They have these loss prevention associates, they call them. So it's just people walking the aisles, but they're wearing like a police-style body cam. And they've come to the psychological and obvious conclusion, well, people are less likely to steal when they think they're being recorded. So just the idea of assigning somebody to kind of patrol the aisles wearing a camera, seems like a pretty simple idea. But I bet it's incredibly effective and cuts down a ton of theft. I mean, nobody wants to do this when they know that they're obviously being recorded up close like that. And I think it seems like a very low cost, pretty simple solution.
Yeah, I was just in Walmart the other day, and I just needed a couple of simple electronics pieces, a plug-in or adapter for a car charger and a couple of different cables. I will say that the service at this location was, I'm not sure what was more enlightening to me, was that there was nobody there to help. And I had to actually chase down an associate just to help another lady get some service, or that, this whole entire aisle was locked up.
Crazy times we're in. Crazy times.
Crazy.
Yeah, next up, new data shows U.S. job growth has been far weaker than initially reported, and this is coming to us from Alicia Wallace at CNN. And I know Ben's got a lot to say about this, and particularly having it been reported from CNN is like a double cherry on that pie here. But some of the numbers that we've been seeing about job growth, which has been weighing in heavily on the Fed's decision around rates, is apparently not as rosy as it was initially thought. So there is some, kind of recalculating of the math that's going to be applied here, where they're going to ramp down the job growth in a couple of significant sectors by some, pretty healthy numbers here, about an overinflation of jobs created by about 818,000, particularly in the professional and business services industry, which is going to be revised down by 358,000 or 1.6%. So there's definitely some kind of refashioning of the numbers that we have in front of us relative to the state of the economy, and in particular how job growth has been affected over the last year or so.
Yeah, Dan, I do have something to say about this one. Well, I am a pessimist at best regarding the political arena here. So I think, honestly, if Harris and Biden, and if he's even making a decision anymore, it wants the Fed rates to come down, well, we have to have some bad news to justify it, so it's not a political move. I think that's, and then CNN, ushering that information out. I mean, between CNN and MSLSD, I think those organizations are like totally nuts. So, I think that, but, the data is the data, and, the market moves on it. So it's important to understand what people are actually interpreting as factual information. So, yeah, I think I think the SPY has some positive opportunity here. Everyone's kind of expecting the Fed rate cut. I think the Fed rate cut, whether or not they announce multiple ones and this, potential soft landing, I think the damage has been done already. I mean, a lot of the smaller companies and organizations you talk to, I was talking to a business broker. He said numbers are down across the board for people who want to sell companies. They're all suffering. So I think that's really very interesting, because that is the grassroots of our country, is the small businesses. And if they're suffering right now, there's more to be seen. And so they, whether we have a soft landing here or not, I think is, would require a lot more work than just a simple rate cut or two. There's going to be a lot of information that needs to be handed out. So those are my thoughts.
Always thinking big picture, never missing an opportunity to slide in a little bit of sleight of hand there by the government and the people that are pulling the levers out there. I love that, Ben. Actually, I hadn't even thought of that until we started discussing this article, and it makes a lot of sense to me too. You guys, you're listening to Money on Tap, and we're going to get into Beyond Brick and Mortar. We're talking about real estate. Yes, real estate is one of the sectors of the S&P 500, one of the 11 sectors. And with that, that's going to do it for us at Money in the News. Don't go anywhere. We'll be right back. You're listening to Money on Tap.
Are you ready to take control of your financial future? Look no further than Brayshaw Financial Group. Our team of experienced advisors is dedicated to helping beginners like you build wealth through smart investing strategies. Visit BrayshawFinancial.com today to start your journey toward financial independence. Brayshaw Financial Group, your partner in wealth creation.
Thank you for joining us for Money on Tap. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's show with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap, and you can reach us at 855-226-8551 or info@yourmoneyontap.com. We are going beyond brick and mortar in the real estate world. Yes, it's our 11th sector of the S&P 500 real estate that we're focused on here for you guys today. Ben and Dan, you guys, there's so much to get into here. And one of the things that's great about this sector, for one, is that everybody has a story inside of it, right? Whether it's been broken out inside of the stock market or not, inside of one of the sectors, everyone has some kind of a real estate story. And it's usually it's one of the places where more millionaires are made, in wealth is generated. People starting out from very little have created wealth inside of real estate, and primarily they start with their own home, and then they start getting into other kind of investments, and they start building in their wealth, their knowledge. But it is one of those key components for building wealth here inside of our market. And that's one of the great things that we can start to take a look at is, first of all, that understanding of, hey, owning real estate, it's real, it's a hard asset, and that's, your home. That's, again, the duplex, triplex, and building on from there, and that giving you some other concepts like cash flow, right, which is so critical when we're talking about retirement and income. And another component there's also taxes and shelters for real estate inside of taxes. And we have shows that are just dedicated only to that understanding. Where we're taking this is hopefully building from that and saying, hey, great, you now have some basics of real estate, or maybe some quite deep knowledge and some very complex understanding of the hard asset of real estate. Well, what does that translate into inside of real estate in the market, this sector in the market? And yes, we're talking about stocks, we're talking about ETFs and mutual funds and different REITs and different forms and versions and flavors inside of real estate that is not necessarily going to be a hard asset that you have to have the mortgage and go through the rest of that analysis and understanding inside of that hard asset, but something that can be purchased and sold in the same day if you're a day trader, if that's where you're going with anything inside of the market. Not what we're advocating here. We're just trying to lay some foundations and some groundwork and understanding here inside of this sector of the S&P 500, and what does it look like and what does it hold for us.
Yeah, in real estate, there's three kind of primary areas. It's residential, commercial, and industrial. And as we've been going through the summer sector series and talking about each sector separately, and then from there kind of the subsectors within and how investments work in terms of trying to highlight or really focus in narrowly on a specific aspect of the given sector. Real estate's a little bit different in this way, that in the ETF space there are perhaps fewer, or definitely fewer, really specific options that exist. A lot of the ETF space, when it is the real estate sector we're looking at, are kind of broad-based, and they're going to encompass those three separate elements: residential, commercial, and industrial. And I would say it's fair to acknowledge that in the last several years, not all of those spaces are performing and having the same supply-demand kind of issues. As we spoke to in Money in the News around Portland, Oregon, and San Francisco, and some of those theft issues, kind of in the heels of the pandemic, some of those inner city commercial real estate markets have been really hit hard. And this whole work from home thing has dramatically affected office space rentals and office space leasing throughout the country, even away from those kind of hot spots. And that is something that will have a kind of a negative drag down effect on a broad-based ETF that's got a lot of those holdings built into it. Now, some people may see that as an opportunity, that this is due to rebound and there's a real recovery to be caught and to be had there. And that may be true if that's your perspective on it. But in the kind of the here and now sense, I would probably lean towards staying away from some of that, unless you really have some time horizon and some really good risk tolerance to ride that. I'm sure that recovery will happen at some point. I just don't know that it's really a near-term thing, and interest rates will play into that heavily as well. But in the REIT space, which is a little bit different, and when I say REIT space, I'm speaking specifically in this moment about publicly traded REITs, okay, which is a real estate investment trust, which will have a ticker and trade just like a stock would on a stock market. So it's something that you can buy and get out of very, very easily. So it's got built-in liquidity. And that's very much limited to the public REIT space. There are other types of REITs that are privately held that do not have those liquidation opportunities. They don't have the built-in liquidity. So you really need to be buyer beware of exactly what you're getting into there. But in the publicly traded REIT space, you do have an excellent opportunity to drill down into some very specific opportunities that exist out there.
There's a lot to real estate, and Dan, I think you covered probably most of the bases generically enough that I think our listeners can really embody the idea of what the general gamut of real estate is. I think when it really comes to real estate, I think people don't really understand the big issues with real estate, because I think people look at real estate as like, well, I bought a house, I sell a house, I buy a house, sell a house. They don't look at the lack, and I think probably the most important thing is they don't look at the lack of liquidity to real estate, or they don't quantify it as, guys, I mean, would you agree with me? Like when we talk about real estate, it's the most illiquid investment you can possibly make, and yet people don't see it that way. It's really incredible to me that there's kind of this vortex of understanding liquidity and knowing like, well, I sell my house if I need money, people actually look at it and say, well, I can go get a home equity line of credit. So that's liquidity. It's really not, and it's not how it's perceived. So a lot of people don't really understand when we talk to people that when you're engaging in real estate, if you don't understand the liquidity piece, you really, really don't understand, how to invest in real estate, because that is really the first tier that I get concerned with people as they look at the different types of real estate, because each one of them potentially has maybe better liquidity, but they're all considered illiquid investments. And do you guys know what I'm talking about when you talk to clients about this stuff, Seth?
Yeah, what I hear a lot of is, familiarity, because people understand or have more experience inside of real estate. That kind of lowers that apprehension that they might have, or the understanding around risk. And risk for a lot of people, or risk aversion for a lot of people, is just purely based off of knowledge and experience. And in some ways, that makes a lot of sense. Like your own business, you take that risk on, which is incredibly high risk, because you are betting on yourself, right? And you're betting on your understanding of the way to maneuver and create and generate income through your own business. Inside of real estate, people have, the story of I live in a home, I bought a home, and taking that next step really is a lot easier for people once they have those understandings. But in terms of, a risk paradigm, risk is liquidity or illiquidity. And that's a big factor inside of what people just need to kind of wrap their arms around here. And one of the opportunities inside of the, owning this sector inside the market is that barrier of entry that's much lower. Pretty much anybody can open up an account and go buy some real estate inside of a market account, brokerage account, and then turn around and decide, hey, I want to do something different tomorrow, and go ahead and get out. And that's one of the things that we're talking about here is understanding that risk and how do we work through that.
Yeah, you spoke to the familiarity of real estate, and I think that's one of the benefits. We've talked a little bit about the risks, but one of the benefits is, when people, have the 2 or 3 family, or they're looking for that, vacation home that they're not going to quite be there all summer, what's really on mind for those folks is income, right? They're going to make an investment that's going to in turn send them back income on a very regular basis, a predictable level of income, by nature of signing a lease with a tenant and, holding them to it and making sure that rent check is coming in all the time. And that's tried and true financial strategy for a lot of American families and has been, for centuries. But that's something that can be had in the investment world without having to put that substantial risk and to take on that illiquidity that comes with closing on a property and then pouring all of that money into it. Back on that notion of liquidity, Ben, you talked with Seth about what you hear from clients. One of the things I hear from clients all the time is they think about the equity in their home as if it's money in the bank. And it's not the same thing, right? It takes some time to extract that equity. There's going to be costs involved with extracting that equity. Whereas money in the bank, it's truly just a heartbeat away. And, people, because real estate has been so hot for so long and everybody's got Zillow and they're looking at it every other day and, they're watching their home value go up and they know what their loan is. And so they're doing this math in their mind. And when you're evaluating net worth, that's important math. And that equity you have in your home is largely, for most people, one of their biggest assets. I have nothing wrong with, with that philosophy and that mentality around, wanting to do well inside of a home. But the notion that it's there and available for you at a moment's notice is just something people got to get a different perspective on. Whereas in the investment world, you can have that.
Well, I think, Dan, that the thing is when you need money out of your real estate, it's probably a time, because a lot of people don't do the preparedness that you really need when it comes to real estate for liquidity, because you really have to have that home equity line open long before an event happens. And banks don't want to lend money to people who just lost their job. Or, you want to go in. We talked to a client, what was that, a month or two ago. He was like, I'm thinking about a job change, this, that, and the other. I'm not really sure what's going to happen. They're doing consolidate. And we just said, you know what? Go get a home equity line of credit. Open it up. Take whatever $2,000, $5,000, $10,000 you need out. We'll pay it off. Keep it open for a few years. It gives you some room to move, because he didn't have really the emergency fund that he had plenty of money in retirement, but that's not emergency fund. You can't take loans if you lose your job from your 401k. So those are the types of things you really need to kind of have some foresight on to really have accessibility to, not being forced to sell your home. Sometimes just having a home equity line, knowing that, I have this value, but I can get a better price if I wait a few months. Now you have the cash to not stress, not to be fearful and to sell for a price that's, maybe way below market. Those are the opportunities. Gives you the ability to negotiate.
You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're getting beyond the brick and mortar today. And don't go anywhere. We'll be right back after these messages. While you are out there, please just take a minute to subscribe to Money on Tap. Drop us a message, and we'll send you out some Money on Tap gear.
Hello, everyone. This is Dan Mickle of Brayshaw Financial Group. Are you looking for professional guidance to kickstart your investing journey? Look no further. Brayshaw Financial Advisors are here to help. Our team of experts will provide you personalized advice tailored to your financial goals. Visit us at BrayshawFinancial.com today and schedule your free consultation. Brayshaw Financial, investing made easy.
And now, here's our Cliff Notes edition of Money on Tap.
One piece about the energy space I think is interesting, and I've been curious because, Trump's like, drill, baby, drill. That was a quote, close the borders. We need to do these things. I get whether you're pro-oil or not pro-oil, you're not going to have power if we don't get more power online because of the demand of the world. You look at the energy companies, and they've made so much money during the Biden administration because closing the doors on oil has made it more scarce, more difficult, right? Which raises the prices, which means they sell it for more. And it's still sitting in storage in the ground. They still own the oil. So creating a scarcity only raises. And when, Ukrainian war and shutting down Russia and all this stuff, it's really made oil companies a ton of money. So it's interesting. If we drill, baby, drill, is the price of gas going to go down, which means these companies make less money, their profits are lower, right? And they're expending their resources. I'm just curious. It could go the other way too.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Thank you for subscribing and dropping us a message. We love sending out some Money on Tap gear. We are in Beyond Brick and Mortar. And that's what we're talking about here at Money on Tap, is getting into the 11th sector of the S&P 500, at least the 11th sector for us this summer, as we're in our summer sector series. We're talking about real estate. And some of the key concepts that we've covered have been liquidity, structure, kind of, the opportunity that we understand, how we understand that. And one of the things we want to talk a little bit about is diversification. So if you right now own your home, let's just say that it's $500,000 home, beautiful home, and you own that outright. Okay, but let's say you also have $1 million portfolio in your 401k, and you've got that structured in whatever you have that in, the S&P 500 or something like that. So right now, you, in terms of your assets, okay, for one, we don't typically include the asset of your primary residence in terms of the assets that are under management. But just for the sake of this argument, right now, you would have a significant concentration inside of real estate in your primary residence, and it's that real estate that you own is just one location, one property, right? And those are factors to consider inside of diversification, what the market can open up an opportunity for. And there's other avenues as well, but just for the sake of today, we're looking at the market. The market can really open up opportunities inside of diversification, right? You can just own real estate in a broad market sense, with a real estate ticker on the general S&P 500, 11th sector. Go ahead and own that ticker inside of the market. But then you can actually start to take a look at different kinds of opportunities. That there's REITs, publicly traded REITs, and those REITs might focus on industrial. They might focus on hotels. They might focus on data centers. There might be Amazon shipping and receiving centers, you name it. There's real estate out there that can get pulled into an asset and focused in on. And that's one of the things that's really cool inside of this sector as well, because there's a lot of diversification or ways to diversify across a sector, a region, a country. How cool is that?
One of the other things that comes with the REIT space is that, depending upon what type of real estate you choose to get into, there may very well be some tax advantages buried in there. The kind of tax advantages that the property itself holds by nature of what kind of business it conducts. But as a share owner inside of a REIT, a publicly traded REIT, some of that tax advantage can be passed through to you. So there are different advantages that you can get that can minimize things along the lines of capital gains and have an effect on how you might view a particular investment, and that might help offset some tax issues you have in other parts of your overall portfolio.
Yeah, I think the tax world is probably one of the areas where we specialize pretty much more than most financial firms. I mean, tax incentive planning is like the core, the heart of our business. And there's a lot of tax incentives, whether you're looking for liquidation of real estate to move in a tax advantageous way to another piece of real estate, or whether you're looking for passive income that, is quantified through the real estate investment trust world. There's lots of different ways to create and avoid taxes or create enhanced, tax savings on distributions. There's a lot of things out there. And I think, if this is the space where you have questions, we get into a lot more complication and not really relevant for air on the radio, but something you should give us a call about. I would encourage you to reach out if you have a tax question on real estate and working through that. Though we're not CPAs, we have them in our office. We have lots of different tax professionals available for you at all different gamuts to address those. But what's really I mean, real estate is one of those things that people just literally depend on for income. Whether you're renting out your apartment in your basement, as I mentioned earlier today in the show, or you have a duplex or quadplex or an office building or two. I mean, real estate has been the driver of much of the wealth in America, and people know that. But it does take a certain kind of person to manage real estate, and it takes a really wise person to know that you're not that person at times. So, some people think that they can do it and they give their hand at it and they lose a lot of money and they say, boy, that was really the biggest mistake of my life. And then other people, they don't mind the phone calls at 2:00 in the morning that there's no hot water, or, they got to run to the office building because, there's a mouse in the place, or whatever the story is, right? You're always, or, one tenant is being loud, and dealing with all those hassles and problems and feeling like you're always tied to the property. If you're older and you say, hey, I've depreciated this property all the way down and now I can't even exit it, but I have all those problems. That's not true. That's something we can definitely help you from a tax incentive standpoint, is exiting in a way where you can mitigate or completely even forego paying taxes, depending on the scenario and situation for yourself. Those are things that a lot of baby boomers are concerned about. Is, I just want to get rid of this property. I can't stand the phone calls. I can't stand the people. Some of these tenants are great, but I just need to get out of it. We're the people to call in that space. And there's a lot of solutions out there for you, and happy to talk more about that.
One of the neat ways that the market can actually help inside of the diversification and ownership of different parts of the real estate market is inside of that market downturn story, right? Because there's just going to be illiquid assets that you hold that you might not have much control over. So having some of the liquidity as a factor in place there is one of the interesting stories inside of the market there as well. Folks, you are listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are getting beyond brick and mortar inside the real estate sector with you guys today. Don't go anywhere. We'll be right back. Hey, this is Seth Cressman with Brayshaw Financial Group. Are you looking for a hassle-free way to invest? Look no further than Brayshaw Financial Group. With Brayshaw Financial Group, you can start investing with as little as $100 and enjoy a user-friendly platform with diverse ranges of investment options. Visit Brayshaw Financial Group and start your investment journey today. Brayshaw Financial Group, investing made easy.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're getting beyond the brick and mortar here today. Thank you for subscribing to the podcast. And when you do that, please drop us a note at info@yourmoneyontap.com. We want to send you out some Money on Tap gear. And thank you for being a part of Money on Tap and here with us today. One of the last things I mentioned was a risk inside of the market and a market downturn. And I think that's one of those pieces that really it needs to be understood. What are the risks? That we've talked a lot about liquidity and, different parts here, but we want to spend a little bit of time understanding this sector and what are some of the risks inherent here.
Yeah, I think the title of this section is, kind of risks beneath the roof, right? Like, you own the property, what's next? What are you dealing with? And we've got kind of 4 general risks that you need to evaluate after you own the property. And one is management costs. I mean, whether you're paying a firm to manage your assets through a real estate program or real estate investment trust, or you have a property manager, management costs are a massive drain on property because you're trying to mitigate the amount of work you do. And a lot of people try to self-manage these things, but sometimes there's a little bit of a mix. We've hired people for some of our office buildings where they kind of fill in the void and they literally take care of stuff. But we're hands-on kind of business owners. We're at the space. We're all pretty handy, and it's nice to be able to deal with the little things here and there. But when it gets a little heavy-handed, you don't want to just hire somebody brand new. So having somebody available and around from time to time, maybe checking on things monthly or quarterly or something, it keeps them active with you and your property. There's people that just do this for a living, and it's a pretty great business model. But yet it is a draw on your cash flow and something that's problematic for a lot of people, because when you buy property, not everybody's making a crazy rate of return. And when you start dealing when you first buy a property, it's like, man, everything needs to be done. You're dealing with problem after problem after problem. Most people sell their property right when it's just before it's going to break. So those are the types of things you need to be careful of. But management costs, I think, is the first one. And then, one of the other issues is the growth of the real estate. Right now, we've been at a real estate boom, and it's really hard to find property when you're buying at a high and knowing, hey, listen, is this really where it's at? And I think that's where, publicly traded REITs and so forth really play a good value space, because if you want a specific area, we're going to get more into this, they're doing the evaluations. They're focusing on location, growth, demand, trajected population growth, all the different things you couldn't even possibly quantify that they're doing. So right now at a market high, you really could potentially be dealing with limited growth and maybe even a loss in that real estate. And those are the first two things that I think, those are the first two things separate from when we start getting into interest rate risk. And I'll pass it over to Dan.
Yeah, I think that's one of the things that's been potentially a growth inhibitor lately in the REIT space is the interest rate environment. These REITs turn over properties and they take in all this investable money, and then they have an obligation to go buy property with it. That's by nature of what they do. They're really designed to not sit on cash. But they too are reading the winds of the market and understanding that interest rates just haven't been favorable in the mortgage world for quite some time, and that cost of the mortgage that they're paying is something that ultimately works against your returns in this space. So as interest rates potentially wane and hopefully are lowered here, I think that's going to pick up a fair amount of excitement in the REIT world and in the real estate world in general, because I feel as though some of these companies are sitting on some cash and looking at some opportunities, but the financing of that deal needs to be right as well in order for it to make sense all around. So that's a part of this story to keep an eye on in these next few months and into 2025 with that lessening of the rate pressure. I think some opportunities will break open in that. And then there's just the general market downturn is the last risk that we need to address. And, that like everything, these markets do go through cycles, and there are times in places where real estate cools off and it falls into that very much illiquid status that we've kind of harped on here is, owning property that you can't sell can be a real drain on your overall financial picture, particularly when you're in a situation where you need to raise cash and find it very difficult to do so. So those market downturns do happen, and we're certainly experiencing that, in the commercial space of real estate right now. These massive office buildings were, tried and true and great investments in the inner city for decades until now. And now they're really an albatross for a lot of these companies holding them, because they can't lease them, can't sell them without taking a massive loss. And it's very hard for any potential bidder to raise the cash to even have a feasible sale, because the rate world just won't finance it the way it needs to work. So those are the key four risks when you're talking about a real estate investment.
Yeah, a lot of factors to consider there. Let's talk a little bit more about REITs, okay? Real estate investment trusts. And there's, if you want to take a look at the sector, for one, you can go ahead and take a look at ticker XLRE for the real estate sector. And inside of that, what you're going to find is that sector as a whole, or that ticker as a whole, is going to own several different parts of the real estate world. And typically, it's going to hold that inside of REITs. So it's kind of almost like a fund of funds, right? There's going to be American Tower Corp, Equinix, Welltower, Realty Income Corp. Now, these are publicly traded REITs, all part of the XLRE ticker, and there's a couple of them, others of them out there as well, that this sector as a whole, they're going to warehouse. And it has been the story for investing in real estate inside the market, and also illiquid outside the market too. It has really been the story of how people own real estate if it's outside of the personal portfolio and the actual holdings that you might have, say a duplex or apartment or something like that. And the breakdowns of these start to get everywhere from broad market to an income kind of a story, and income producing properties, and that driving the story there, healthcare, and one of the fun things that we're going to take a look at here, I say fun just because it's pretty new and exciting, and it's developed over the last 10 years, has really been the data center story. And this has been around for a while, but why has it come back with such a popular vibe to it? Any guess? AI. And we've talked about this how many different times, driving the market and the need for data, and that data needing a place to store. And guess what that means? Real estate, you guys. There's nothing that this story isn't really touching. And, does that mean that we're not making recommendations, right? I just want to make sure people are clear. It's not a recommendation. It is something that's worth taking a look at and trying to understand, because I bet you anything you already have it. If you own part of the S&P 500, right, you're a part of the story inside of this as well.
Seth, I think when it comes to the ETF space and the REIT space, there's ETFs of REITs, which are charging you fees on top of, REITs that have their own internal fees. So you can get a little fee heavy. So if you feel you're competent in working in this space, probably buying the actual traded stock, or the REIT on the open exchange is probably a better way to go. I think you make a great point. The AI space is really interesting, but I love owning the actual ticker. I like owning the stock because those dividends flow right in. It's new cash, new income. I can go take that money and I can reinvest it in something else that I think is attractive and opportunistic today. I love getting paid to wait. Those are great concepts to do. People don't do that enough. Get paid to wait. Look for value, look for yield, look for dividend income stocks. Try to find yourself a place where you believe in a company, can collect a dividend, get paid to wait for them to actually make things happen the way you believe them to be. It's boded well for us as a firm. It'll bode well for you if you find the right company. And I think that's part of it. And REITs can play a nice piece in that space.
Yeah, I think an interesting REIT is kind of like the inverse of the AI data center play, and it's Iron Mountain, which is the ticker for that is IRM. And for any of us who've ever worked in a big office, you're probably familiar with those Iron Mountain boxes kind of getting stacked up and shipped off every once in a while. Like as we transition from the paper-intensive record-keeping obligations that we have in the professional world to this cloud-based AI, it's all on a drive, and it's a password away. But as that transition's happening, we still have tons and tons and tons, and literally mountains, appropriately enough, of paper records that we need to first maintain and store and then ultimately destroy. And that's where Iron Mountain's spot is. So for all these companies that are downsizing and transitioning out and undoing these file cabinets, floor to ceiling all over the place, that's all going someplace, and Iron Mountain's the key player in that space.
Something that I actually forgot to mention was the dislocation that you can get from the sector in real estate from the market, right? That's part of the diversification story. So if you're really wanting to try to understand more of that, we've got another show for you. But for today, you guys, that's going to do it for us here at Money on Tap. Thank you for joining us for Beyond Brick and Mortar, our real estate inside of the S&P 500 show. It's been a lot of fun, and we appreciate the subscribes. We appreciate you guys being here with us today. And you know what? Want to appreciate you for investing in yourself and taking the time with us here today to do that. And be successful. Be successful in your investing. Thanks for joining us. We'll see you here next week.
All season long, it's Money on Tap's Summer Sector Series. Each week exploring a different high-growth industry, analyzing major players, market trends, and emerging opportunities. Join us again next week for more smart, sizzling investment opportunities here at Money on Tap. The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of Osaic Wealth Incorporated. Osaic Wealth Incorporated and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire 03110, and can be reached at toll-free 855-226-8551.